Hello, everyone. Welcome to chapter 6. As we move right along, this is our last chapter before we attempt the midterm next week. So, this chapter deals with inventory. And along with inventory, which is an asset, once we sell that inventory, it is no longer an asset and it goes into cost of goods sold, which is part of the income statement. And it is basically an expense. Now, guys, as I'm doing this, you have questions, feel free to butt in and not butt in, you know what I mean. Just step in and just ask questions. So basically, when a manufacturing company creates inventory, we have various categories and accounts showing the creation of the inventory, starting with direct materials, direct labor, factory overhead. It goes into finished goods, which is ultimately your inventory. And then when we sell that inventory, it goes into the cost of goods sold account. Merchandising companies purchased finished goods such as Target or Walmart or Best Buy. So there are different types of companies. And again, understanding the accounting of manufacturing companies will be the subject of the Business 2126, the managerial accounting, for those of you that need to take that. Inventory includes items that are going to be sold to customers. It includes items that aren't yet finished products. Inventory is considered a current asset in the balance sheet. But then once it is sold, it will be put into cost of goods sold in the income statement, which would be treated as an expense. Here you see the breakdown of either a merchandising company or a manufacturing company. The inventory in a merchandising company is basically sold to wholesalers and to retailers. In a manufacturing company, inventory is broken down into raw materials. Those raw materials, when they start creating a product, are transferred into an account called work in process. And then once those materials have completed the product, they are then placed into finished goods. All raw materials, work in process, and finished goods are all current assets. So here you can see the balance sheet, or a portion of the balance sheet, for Intel and for Best Buy. As you see with Intel, they have several categories in their inventory accounts: raw materials, work in process, and finished goods, because they're a manufacturing company. Whereas Best Buy just has merchandise inventories for sale. So depending on the company, the way inventory costs flow with a manufacturing company, they purchase raw materials to make their desired product. Those raw materials, along with actual labor that is utilized just to work on the products to sell, along with what we call manufacturing overhead, which are the other costs to help make the product, but might not be directly associated with the product are all put into an account called work in process as they are working on the products. Once those products have been completed, they're transferred into a sub-account in inventory called finished goods. From there, it's where merchandise companies purchase those finished goods from manufacturing companies and then sell them to the end user. And the end user could be a service company like myself or like our college. We purchase those products, and the service that we're providing in the case of the school is education. Service companies record revenues when they provide services to customers. But merchandising and manufacturing companies record revenues when they sell inventory to customers. So, guys, we're going to start with our first question of the day. Which of the following inventory accounts consist of items for which the manufacturing process is completed? Is it A, raw materials, B, work in process, C, cost of goods sold, or D, finished goods? I'll let someone pipe in and answer that one. Okay, I see a couple of them going into the chat box. D, 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 D. You are right, guys. It is D. It is the finished goods. Raw materials, inventories, the cost of the components that will eventually become finished goods. Work in process consists of products that are not yet complete, and cost of goods sold is an expense account. It represents the cost of inventory that was sold during the period. Now, we're going to talk now about what we call a multiple step income statement. So basically, inventory is on the balance sheet. Cost of goods sold is that inventory that was sold during the year. So we begin each period with an asset called beginning inventory. That is our inventory that is on hand. We make purchases during the year, which is part of inventory. We make purchases like raw materials. The beginning inventory plus those purchases equal total inventory that is available for sale. Then, between that inventory that is available for sale, we will end up with either that inventory being sold or that inventory not being sold. If the inventory has been sold, it will go into a category in the income statement called cost of goods sold. If the inventory is not sold, it will go into an account called finished goods, or in this case, it's ending inventory, is assets that are still in the balance sheet. So know this formula, guys. Know that the beginning inventory plus purchases equal total inventory available for sale. That will be either inventory not sold or inventory sold. Excuse me one second. Okay. Inventories, a current asset reported in the balance sheet and represents the cost of inventory that's not yet sold. at the end of the period. Cost of goods sold is an expense reported in the income statement and represents the cost of inventory sold. So let's look at this one. Cost of goods sold is A, reported in the income statement, B, reported in the balance sheet, C, a current asset, or D, the cost of inventory on hand at the end of the period. What do y'all think? It's reported in the income statement because it is an expense account. Here is an example of a multiple step income statement. Basically, it's just the way it's broken down. You see the revenues minus the cost of goods sold is what we call gross profit. Then our various operating expenses, such as selling, general, administrative expenses, depreciation, then are shown to get to operating income. Then we'll have some other income and expenses, such as gains on investments, other investment income and interest expense, to get to a category called income before income taxes. We then have our income tax expense to get to net income. We call it a multiple step income statement because we see here multiple levels of profit. So no, a multiple step income statement is an income statement that reports multiple levels of profitability. Gross profit equals the net revenues minus the cost of goods sold. Operating income equals gross profit minus operating expenses. Income before income taxes equals operating income plus non-operating revenues and minus non-operating expenses. And then net income's all revenues minus all expenses. So which level of profitability is considered profit from normal operations? It would be called operating income. Now, we will look at various inventory cost methods. So when we purchase inventory, we have a variety of ways in which we can account for this inventory. One method is specific identification, which means we match each unit of inventory with its actual cost to purchase it, such as unique items, maybe rings that are specific and unique to themselves, or automobiles. We may also, on other types of products, generic products, use an inventory method called FIFO. First in, the first inventory we've purchased is the first ones we say, for costing purposes, we are selling. There's another method called LIFO. The last purchases of that inventory that we've purchased are the first ones we say we are selling. Now, guys, know this is just for purposes of financially stating on the books. We always are going to sell our oldest inventory first, unless it is totally outdated. Then we're not going to have it in our inventory. But for purposes of our books, we generally can choose. Do we want to do FIFO, which means the first units purchased are the first ones we sell from an accounting perspective? Or do we do LIFO? The last ones we've purchased are the first ones we say we sell. Or we can also do one called the weighted average cost, where we assume units sold come from a random mixture so it shows they're all weighted by an average. So we're going to look at the various methods here. And this one, we're going to take inventory from Mario's Game Shop. We see the beginning inventory on January 1st was 100 units. It's $7 a unit for a total cost of $700. Then on April 25th, we have a purchase of 300 units at $9 a cost for a total there of $2,700. Then on October 19th, we have a purchase of 600 units at a cost of $11, for in that case, a total cost of $6,600. So what's available for sale? 1,000 units at a total cost of $10,000. Let's say we sold 800 of those 1,000 units, and we have left in inventory 200 units left in ending inventory. So you can go back to that formula we talked about. Our beginning inventory plus our items purchased, our total inventory available for sale. And that total inventory available for sale will be broken into finished inventory, or remaining inventory, ending inventory, and the other piece would be cost of goods sold, those items that were sold. Now, we're going to look at these three methods based on this example. If we use the FIFO method, what that means, the first items in are the first items we're going to sell. So if we sold 800 units, that means we sold 100 units from our beginning inventory. We sold 300 units from our April 25th purchase. And the October 19th purchase of 600 units, we sold 400 of those 600 units. So you see here, under FIFO, we take the cost, 100 units at $7 of the beginning inventory. We take the April 25th purchase, 300 units at $9 a cost, for a total of $2,700. We take 400 of the 600 units on October 19th times $11 a unit cost for $4,400. So our cost of goods sold using the FIFO method, meaning the first ones in are the first ones we're going to say we sold, our cost is $7,800 here. And the 200 units, the very last ones on October 19th, are the ones we are going to say are still in our ending inventory. So we still total the 10,000. by the 7,800 being sold, the first batch, the ones we sold, and the ending inventory would consist of the most recent purchases. Now, if we go the LIFO method, what that means is the last items we have purchased are the first ones we are going to say sold. You see here, the last items purchased, October 19th, 600 units, and 200 of the 300 units purchased on April 25th. So those 800 units were the last ones we've purchased. We're going to say for accounting purposes, those are the first to be sold. Now, the items that remain in our ending inventory are going to be the oldest units, the ones from the beginning inventory and the oldest units we have purchased, which would be those in our beginning inventory on January 1st and 100 of the units purchased on April 25th. So in this case, the cost of goods sold would be 8,400 and the ending inventory would be 1,600. Now, students think it's weird that companies are allowed to report inventory costs using assumed amounts rather than actual amounts, but all companies sell their inventory in a FIFO manner, meaning they are going to sell their oldest items first and then sell the newer items later. But for reporting purposes, they are allowed to determine if to say they sold it in a LIFO manner. Let's look at this one. And guys, I want everyone to attempt this. This isn't to try to be mean. It's really so I know if it's working, if it's clicking for you. Company has the following inventory transactions. So it starts the beginning inventory on January 1st with 100 units at 400, or excuse me, at $4 each. Then on January 15th, purchased 100 units at $5 each. Then on January 31st, purchased 100 units at $6 each. What would be the cost of goods sold under the FIFO method if 120 units were sold in January? Would it be A, 600, B, 500, C, 620, or D, 720? Any ideas?
B. I chose B.
Thanks, June. B. How many of you guys picked B in the chat? Let's see. Whoopsie. Did I just screw up? I wanted that one. Chat. B, A, B. So some had A, some had B. And as you can see here, can you guys see my screen? I'm so sorry about that. It is in fact B. So if we sold 120 units, we're going to have sold all the beginning inventory using FIFO. First ones in are the first ones out. And then we're going to have sold 200 of the January 15th purchase, which is 20 units at $5 each. Okay. Here's another one. What would be the cost of goods sold? Same information, but using the LIFO method. What do you guys think here? How many pick C? So basically, what we would do is the last ones in are the first ones we are going to say were sold. So it would be the 100 units at $6, the January 31st purchase, and then 20 units of $5, showing $700 would in inventory would have been sold. Okay. Now we have another method we're going to talk about. This method is called the weighted average cost. Now, know this weighted is really important because we are going to assume the cost of goods sold and the ending inventory consist of a random mixture of all the goods available for sale. Now, each unit of inventory has a cost equal to the weighted average unit cost of all inventory items. So as you see, the cost of goods available for sale divided by the number of units available for sale will give us our weighted average cost. So if you see, we had 1,000 units and we paid $10,000 for those 1,000 units because we purchased different quantities. Our beginning inventory, we had 100 units at $7. Then we purchased 300 units at $9. We purchased 600 units at $11. So we had different quantities of the different prices. That's why we need to weight them. But if we divide the total cost divided by the total number of units, you see we end up with $10 per unit. That makes sense? So in this case, if we sold 800 units, we're going to assign that $10 cost per unit to both our cost of goods sold, and we're also going to assign it to our ending inventory, the $10 per unit. So if we sold 800 times $10 is our Cost of goods sold of 8,000. If our ending inventory is sitting at 200 at 10 bucks, our ending inventory is 200 units, would be 200 units times 10 bucks or $2,000. No, when you're doing the weighted average unit cost, make sure to use the weighted average of the unit cost instead of a simple average. Remember, we purchase different quantities, so we have to weight them by the number of units. So when we compare these three options, these three ways of measuring inventory, we see that using FIFO, the very top one, our cost of goods sold is 7,800. Our ending inventory is 2,200. When we use LIFO, our cost of goods sold is 8,400. Our ending inventory is 1,600. And when we use weighted average cost, we're going to be right in the middle of the other two. Our cost of goods sold is 8,000. Our ending inventory is 2,000. Do you see in this scenario, using the FIFO method, our cost of goods sold is the lowest number, with our ending inventory being the highest number. LIFO is the exact opposite. And weighted average is right in the middle. Companies, again, are allowed to report inventory costs by assuming specific units of inventory are sold or not sold, even if this does not match the actual flow. The three major inventory cost flow assumptions are FIFO, last in, first out, LIFO, last in, first out, or weighted average cost. Now, what I want us to do is let's work on a problem. So we can clearly go through how, how we go through these, this example. Let's look at exercise 6.4. For the entire year, the company, so during the year, TRC Corp has the following inventory transactions. We began the year with 60 units at 52 bucks a cost for 31.20. On April 7th, we purchased 140 units at 54 bucks a cost for a total cost of 75.60. On July 16th, we purchased 210 units at a cost of 57 bucks for a total of 11,970. And then on October 6th, we purchased 120 units at a cost of $58 per unit for $69.60. For the entire year, the company sells 450 units of inventory for $70 each. So we're going to calculate the ending inventory and cost of goods sold using FIFO. And then we're also going to show the sales revenue and the gross profit. Now I'm going to tell you the sales revenue is going to be the same in all three scenarios because the sales revenue is what we sold the goods for. That's going to be the same. But our gross profit is going to be unique in all three items. So in this scenario, we're going to look and we're going to do this using FIFO. We're going to do it using LIFO. And then we are also going to calculate this using the weighted average cost method. And we're going to decide which one of these methods results in a higher profitability when inventory costs are rising. So when inventory costs are rising, that means the ones that we've purchased the most recent are going to cost the most. Okay? If we go and look at this exercise 6.4, we're going to see here oops, I went way too far. Exercise 6.4 will show us using FIFO. We would show go back here so I make sure. Calculate the ending inventory, the cost of goods sold, the sales revenue, and the gross profit. So if we had cost of the number of units available of 530 and we sold 450, that would mean 80 units are in ending inventory. Using FIFO, the first ones in are the first ones out, the first ones we sell. That means the ending inventory would consist of 80 of the units purchased on October 6th for $58. So our ending inventory would be the newest units we've purchased, 80 at $58 for an ending inventory of $46.40. Using FIFO, the 450 units would consist of 60 at $52 for the beginning inventory, 140 units of $54 on the April 7th purchase, the 210 units at $57 on the July 16th purchase, 40 units at $58 on the October 6th purchase, for a total of 450 units. Cost of goods $24,970. The sales revenue would be the number of units sold times $70 a unit. That's going to be the same in every example. But our gross profit is going to be our sales revenue minus our cost of goods sold. And under the FIFO method, our cost of goods sold is $65.30. Now, when we use the LIFO method, we're going to show that our ending inventory would be the very oldest items, because LIFO means the last ones in are the first ones we sell. So our ending inventory is going to be our beginning inventory on January 1st, 60 units at $52. Then the first purchase, April 7th, 20 units at $54 a unit cost, for a total here of $4,200 would be our ending inventory, which means the items we sold are the most recent ones we've purchased. So that would be the October 6th purchase of 120 units, the July 16th purchase of 210 units and a portion of that April 7th purchase, 120 of those units. In this example, our ending inventory is 4,200 and our cost of goods sold is 25,410. Meaning our gross margin, or excuse me, gross profit in this scenario is $6,090. Our sales revenue minus our cost of goods sold. Now, when we do the weighted average, we're going to come in the middle. We always will. We have to go and take every transaction along with our beginning inventory, come up with a total cost. 60 units at $52 gives us $31.20. 140 units at $54 gives us a cost of $75.60. July 16th purchase, 210 units at $57 is $11,970. And then the October 6th purchase, 120 units at $58 is $69.60. If we divide the 29,610 divided by 530 units, we end up with a weighted average cost of $55.8679. We carry it out because that's going to change our numbers. What's our ending inventory? We're going to take our 800 units times that weighted average unit cost of 55.8679. And our cost of goods sold, we're going to take our number of units that are in our ending inventory times the 55.8679. Again, we know our sales revenue is not going to alter. And our gross profit is going to be $6,359. Now, we see in this example, FIFO will always result, in this case, in the time of increasing prices, FIFO's gross profit is going to be the highest at $65.30. LIFO is going to be the lowest when there's a time of rising prices. And the weighted average will always be in the middle. The 63.59, the weighted average will always be in between those two numbers. Okay? So, no, FIFO is matching generally the physical flow that most companies do with the reporting numbers. LIFO, cost of goods sold, reflects the current cost that these items are purchased for. And the LIFO conformity rule, basically, companies that use LIFO for tax reporting must also use LIFO for financial reporting. Most companies do use FIFO. I'd say over 90% of companies still use FIFO. Remember here, the choice of inventory methods does affect the reported ending inventory shown as an asset, the reported cost of goods sold, which is the expense, but will ultimately affect our profit. The LIFO difference is when items in inventory are reported under LIFO. The LIFO difference just shows the effect a LIFO presents on the income statement. FIFO more closely resembles the actual flow of inventory. When inventory costs are increasing, FIFO is going to result in a higher reported inventory in the balance sheet and higher reported income in the income statement. But the opposite's true when we're dealing with LIFO. LIFO is going to result in a lower reported inventory in the balance sheet, and it's also going to have a lower net income in the income statement, which ultimately reduces the income tax, the company's income tax obligation. So guys, what do you think here? During a period of rising prices, which inventory cost flow assumption would result in the highest cost of goods sold and thereby the lowest net income? FIFO, LIFO, weighted average, or FILO? Any ideas? Using LIFO, we will assume the last units purchased are the first ones that are sold. If prices are rising, cost of goods sold would be composed of the latest and of the highest costs when we use LIFO. And then this question, which inventory method or cost flow assumption most likely resembles the actual physical flow of goods? FIFO, LIFO, weighted average, or FILO? And you know it should be FIFO. Now, we're going to take this next section and understand how we go about recording these various transactions. We can use what's called the perpetual inventory system, or we're going to learn how to record goods using the periodic inventory system. When we use the perpetual inventory system, which has become the most common just due to our ability to have computers keep track of the products on hand, this perpetual system maintains a continual record of inventory, and it really helps companies know their levels of inventory on hand. The periodic system doesn't maintain a continual record of inventory and will periodically adjust for the purchase and sale of inventory. So we're going to learn how we record inventory under the two different methods, and knowing it's a totally different accounts we use. The names of the accounts are different. So you want to be familiar with each, because you will have a problem that you're going to need to do on your midterm for each way. When we use a perpetual system, and we purchase inventory, we're going to debit our inventory and we're going to credit our accounts payable. So we use the category using the perpetual system, inventory, and we credit our payable. This increases the balance of the asset inventory, and it also increases the balance of the accounts payable, which we know is a liability. Now, when we sell products using the perpetual method, you'll see that it's a two-step process here. The first is recording the sale. We record the sale by debiting on account. We would debit our accounts receivable for the sales price of 300 units at $15 a unit. And we would credit our sales revenue for the same amount. Okay. Now, we also need to take into account the inventory. So it's a two-step process here. We would debit our cost of goods sold for 100 units at $7 and 200 units at $9. And we would credit our inventory. So we debit our cost of goods sold, our expense account. We credit our asset inventory because it is no longer in inventory. We have sold it. No, the revenue will always be the sales price. It will always be the sales price. Know that the cost of goods sold is always the expense. On our T account, you'll see we show our April 25th purchases. We'll show our October 19th purchases, and we also will credit our sales here. We're going to credit out the inventory when we sell items, so we show them going into our cost of goods sold. Now, the LIFO adjustment basically means that when companies choose to do LIFO, they generally still record their books using the FIFO method. And so at the end of the period, they will adjust their books to show the LIFO amount by what we call a LIFO adjustment. The difference in reported inventory when using LIFO instead of FIFO, we call the LIFO reserve. So when Mario's ending inventory using FIFO was 2,200, but it would have been 1,600 under the LIFO method, we would then show a LIFO adjustment, meaning we would debit our cost of goods sold to increase our expense, and we would credit our inventory. Debit 600 cost of goods sold, we would credit our inventory for those companies using LIFO. And since the books are always done on a FIFO method, we would create what was called the LIFO adjustment to show the difference in the figures. Now there's a couple other items that are added to inventory. When we have freight charges, there are the freight in means shipments that we pay for from suppliers. Freight out would be shipment we pay for to customers, to send things to customers. We may also have purchase discounts. Remember that discount that we offer to sellers if they pay their bill within a certain amount of time. We allow them a discount, 210 net 30. That reduces our inventory. And when there are purchase returns, when the buyer returns unwanted or defective inventory, we may have to make adjustments then in our inventory transactions. So the two methods regarding shipping are when the supplier, we purchase items and we have an agreement with the buyer, or excuse me, the seller, we're the buyer, that says it's FOB, free on board, shipping point. What that means there is we are responsible for paying for shipping. The title passes to us, the purchasers of the goods, at the shipping point when the inventory leaves the warehouse of the supplier. In that case, Mario would record the purchase of the inventory on April 25th because we have title to those goods. We're paying for the shipping. We then own those goods. So if something happens to those goods while in transit, it's on Mario to make sure those are insured. If the shipping terms are shown FOB, free on board destination, then what that means is the title to those goods passes at the destination when they finally arrive at Mario's place. In this scenario, if the shipping terms are FOB destination, Mario's not going to record the purchase of these goods in their books until April 29th when they arrive at Mario's dock. This is a really interesting item, and I'd love to know what these costs are today. But the cost of sales consists of the purchase price of consumer products and inbound and outbound shipping costs. This is for Amazon. And in 2014, their costs of shipping totaled $4.2 billion. Now, I don't know about you, but we have Amazon coming to our house, probably not daily, but definitely weekly. We purchase so much from Amazon because it's such a great deal. We don't have to go to the store and lug the dog food or into the house, and it's for the most part free shipping, and the prices are extremely comparable. So we do a lot of our buying on Amazon. Hey guys, I want you to take a moment and attempt this question. Okay, so which of the following transactions would increase the balance of the inventory account for a company using the Perpetual inventory system? Would it be cost of incoming freight charges on merchandise, a return of damaged inventory to the vendor? Would it be a a purchase discount taken for prompt payment, or shipping charges for outgoing inventory? Which of these would increase the balance of the inventory account? going to be A. So cost of incoming freight charges of merchandise inventory is added to the inventory account. The return of damaged inventory would decrease our inventory account. A purchase discount taken by prompt payment would decrease our inventory account. And shipping charges for outgoing inventory are not included in our inventory. They would be included in a separate line item that would end up netting for operating income. So they would be in the sales, the cost, sales, and other admin expenses that would end up then totaling our net income from operating income. So, as you see here, the gross profit from Mario's Game Shop after those some additional transactions, the freight charges minus any purchase discounts, will show that our sales revenue is 12,000 and our cost of goods sold are increased from freight charges and they're decreased from purchase discounts. So our gross profit would be $3,954. I might have said this incorrectly. The purchase discount are when Mario utilizes paying the products within a certain time frame. Therefore, Mario gets to record a reduction in the inventory because we don't have to pay that full price since we took advantage of the discount, since we paid during the time allotted to receive that discount. So you see here, when we look at the purchaser in the transactions versus the seller in the transactions, if the purchaser's Camcorder Central and the seller is Sony Corporation, you see here that on when we purchase inventory on account, we debit our inventory and we credit our accounts payable. Sony, when they sell products on account, they're going to debit the accounts receivable, credit the sales revenue. Then, when there is a return, we returned products. Camcorder Central is going to debit the accounts payable because we're not going to owe as much, and credit our inventory. However, Sony is going to debit an account called sales returns. They're going to credit the accounts receivable. And then when payment is made within the discount period, Camcorder Central is going to debit the entire account payable, but we will credit to inventory the discount we were able to take, and then credit cash the amount we pay. Whereas Sony, when dealing with the discount, is going to debit the cash they received. Sony's going to keep track of these sales discounts, and then Sony will credit the entire accounts receivable since it was satisfied in full. Now, let's look here at exercise 611 and 612. And we're going to understand how we go through the process of recording these journal entries. We're going to record the transactions of DS Unlimited, assuming the company uses a perpetual inventory system. Then when we're done with that, we're going to record the transactions of Game Girl, assuming the company uses a perpetual inventory system. So DS Unlimited has the following transactions during August. So let's look at these. First transaction is on August 6th. DS purchases 70 handheld game devices on account from Game Girl for $200 each. Terms 110 net 60. We're going to record that as a debit to inventory for $14,000 and a credit to accounts payable for $14,000. Then on August 7th, we pay $400 to Sure Shipping for freight charges associated with the August 6th purchase. So in that case, using the perpetual method, we're going to debit our inventory for $400 and we're going to credit our cash for $400. Next, we're going to look at on August 10th, we returned to Game Girl 6 game devices that were defective. So we are going to debit our accounts payable for $1,200 and we are going to credit our inventory for $1,200. We're reducing what we are purchasing. Then on August 14th, we are going to pay the full amount. Since we are paying within the discount period, we are going to be able to reduce the amount we owe by 1%. So we're going to debit the entire accounts payable. We are going to be able to credit our inventory by 1% or $128 because since we are paying within that allotted time, we get to reduce the purchase price of that inventory. And then we also credit our cash. Okay. Then on August 23rd, we sell 50 game devices purchased on August 6th for $220 each to customers on account. The total cost of the 50 game devices sold is $10,212.59. So we're going to have two transactions here. One is to record the sale, which is a debit to accounts receivable for $11,000, a credit to our sales revenue for $11,000. Then we need to take it out of our inventory and put it into our expense account, cost of goods sold. We will debit our cost of goods sold for $10,212.50, and we will credit our inventory for $10,212.50. Now, the transactions for Game Girl are going to have different accounts They are the ones that sold the products, and we were showing when the purchaser of those products. So in selling the products, we are going to debit our receivable, we're going to credit our revenue for 14,000. And then we also have to take it out of inventory and put it into cost of goods sold. So we debit our cost of goods sold for 12,600 and we credit our inventory. Then when we had a return, we debit our sales returns because we like to keep track of those, and we credit our accounts receivable because the amount they owe us will be reduced. Then when we receive the cash, we're going to debit our cash. We're going to debit our sales discounts, and we're going to credit the entire accounts receivable. Okay? There are times when we need to understand what it means to have the lower of cost, or what we call net realizable value. This is a guideline that is in place for inventories we're going to talk about. So basically, at the end of the year, we have to look, because during the year we record all inventory purchases at cost. Then at the end of the year, we've got to look and say, okay, which would be lower for the unsold inventory? Is the cost lower? Or is this new term we're going to call net realizable value, which is the estimated selling price of the product minus the cost to sell the product? If the net realizable value is lower than the cost of the product, we're going to need to adjust our inventory. In order to be conservative and to always show our assets at the conservative figure, we never want to overstate our assets. If in fact the cost is the lowest figure, then there's nothing we need to do at the end of the year. However, if the net realizable value is lower than the cost of the unsold inventory, we're going to need to make an adjustment. So here's an example of why this would work. Fun stations. Fun Station 2 was hot in the, it can just be like the various Nintendos or game stations that are out there now, PlayStations. Fun Station 2, they have on hand at the end of the year 15 units. Now, the cost per unit is $300. That's what we bought it for. But the net realizable value of PlayStation 2, Fun Station 2, is only $200 a unit. In that case, the difference between cost and net realizable value, the lower is net realizable value. They have now become a little antiquated because we now have Fun Station 3 out there. So in an example such as this, we need to adjust our inventory to show that the net realizable value is in fact lower than the cost of Fun Station 2. Therefore, we need to adjust our books by $1,500. And what we'll do is go ahead and expense that difference. We will debit our cost of goods sold by $1,500, and we will credit our inventory by $1,500, because the lower between cost and net realizable value is the net realizable value. Therefore, because of that, we're going to need to make an adjustment in our books. So let's look at this problem, guys. I want you to take a couple minutes and I want you to key in your answer or what you think the answer is. At the end of the year, a company reports the following inventory amounts. Item A, number of units 150, the cost is 4, the net realizable value is 8. Item B, number of units 150, the cost is 8, the net realizable value is 6. Now, the amount to report for ending inventory using the lower of cost or net realizable value is, what is it, guys? A, 1,600, B, 1,700, C, 2,000, or D, 1,300. Take a moment and put your answer in there. How come I can't? Okay, there. ADAAA. Anyone else? Some D's, some A's. Okay. So basically, the correct answer here is D. Because we're going to take item A, the lower of cost or net realizable value. Well, in this case, cost is lower than net realizable value, so that's going to be 100 units at $4. Then item B, 150 units at the lower of cost or net realizable value. Well, in that case, net realizable value is $6. So we're going to show our ending inventory to be $1,300. Let's take this one. Tell me what you think here. At the end of the year, a company reports the following inventory amounts. A, 100 units, cost 4, net realizable value 8. B, number of units 150, cost 8, net realizable value 6. The year-end adjustment using the lower of cost or net realizable value should include what? Okay. So in this case, it would be a credit to inventory for $300, and the debit would be to cost of goods sold. Let's look at exercise 614. Honey, I'm sorry. In this case, a company like Golf USA sells golf-related inventory, typically will have inventory items such as golf clothing and golf equipment. As technology advances the design and performance of the next generation of drivers, the older models become less marketable and therefore decline in value. Suppose that in the current year, Ping introduces the Mega Driver 2, the new and improved version of the Mega Driver. Below are amounts related to Golf USA's inventory. Calculate ending inventory using the cost of lower of cost or net realizable value. Record any necessary adjustments to inventory and explain the impact of the adjustment in the financial statements. Okay. So the ending inventory using the lower of cost or net realizable value here, you see the Mega Driver, the net realizable value is lower than the cost. For the shirts in the Mega Driver 2, the cost is lower. So in this example, we're going to debit our shirt, for shirts, it's going to be the cost is lower for an ending inventory in shirts of 2,100. For the Mega Driver, 15 left, the lower of cost or net realizable value is net realizable value. And our ending inventory in that case is 3,750. Then the Mega Driver 2, the lower of cost or net realizable value is cost. For a total ending inventory here of 16,350. To make the adjustment for the Mega Driver, we're going to debit our cost of goods sold, we'll credit our inventory for the write-down of $1,650 for that Mega Driver. Debit our cost of goods sold, we credit our inventory. So this write-down of inventory basically reduces our asset, increases our expenses, and ultimately decreases our net income, which also reduces our retained earnings. But again, the requirement is to be conservative with our ending inventory numbers. And if the net realizable value is indeed lower than the cost, we need to adjust accordingly. So these are the various ratios you can look at on your own. I'm not going to worry about these. But what I do want to do is look at using the periodic inventory system. When we use the periodic inventory system, we will use different accounts. It doesn't modify inventory amounts continually. Periodically, it will adjust for the purchase and sales of inventory at the end of the reporting period or when a physical count has actually been done. So we're going to go back to our Mario scenario, and we're going to look at the various transactions and see how we're going to go about reporting these. So as you see here, the first transaction using the periodic system, we will debit purchases for 2,700 and credit our accounts payable. You see the difference? With the perpetual system, we debited inventory and we credited our accounts payable. Now, when we sell inventory on account, this is important. We only are responsible for one journal entry using the periodic system. We debit our accounts receivable and we credit our sales revenue. We do not provide a journal entry for our cost of goods sold because we will account for that at the end of the period when an actual physical account of the goods are shown. When we pay for freight charges, we debit an account called freight in, we credit our cash. You notice with the perpetual method, we debit inventory. We don't do that under the periodic method. When we pay on account with the 2% discount of $54, as you see here, we debit the accounts payable. We credit purchase discounts. We don't credit our inventory. And we credit our cash. Then when we make a return, we debit our payable and we credit purchase returns. So as you see, the difference is under perpetual, we do everything through the inventory. But under periodic, we don't. We have purchase returns, we have purchase discounts, and we have freight in. So it's really important you guys understand the differences. Under the periodic system, we will create a period end adjustment. We have to create this period end adjustment because during the year, we don't record any adjustments to our inventory and cost of goods sold. So at the end of the year, we have to adjust the balance of inventory to its proper ending balance. And we need to record the cost of goods sold for the period and then zero out all of these temporary accounts. So we are going to debit our ending inventory. We're going to debit our cost of goods sold. We're going to debit our purchase discounts. We're going to debit our purchase returns. We're going to credit our purchases, credit our freight in, and then credit our beginning inventory. So basically what this does is it creates the appropriate true ending inventory for the period, and it creates the appropriate cost of goods sold for the period. Now, as you see here, the multiple step income statement for Mario, using this periodic method, you'll see we've got our beginning inventory. We add our purchases and freight in. We subtract our purchase discounts and purchase returns to get the costs of goods available for sale. Those costs of goods available for sale less our ending inventory is going to be our cost of goods sold. Then we know our revenues minus those costs of goods sold give us our gross profit. Okay, we'll do a problem like this, but let's take a moment and look at this question. When a periodic inventory system and the FIFO method are used, which of the following is correct? A, the inventory account will be continuously updated. B, the amount of cost of goods sold will be the same under a perpetual system in the FIFO method. C, the cost of goods sold account will be debited for the cost of each sale made. Or D, the amount of ending inventory will be larger under the perpetual system and the FIFO method. Take a moment, key in your answer. The periodic system and the perpetual system always are going to produce the same amount of cost of goods sold and ending inventory when FIFO is used. The only difference is the periodic system doesn't maintain a continuously updated inventory account, nor does it maintain a continuously updated cost of goods sold account. So DS Unlimited has the following transactions during August. We are going to take this same problem we did using the perpetual system and apply it to the periodic system. Okay, so here you're going to notice the account names are different. Do you see? We show purchases of 14,000, we credit our payable. We're not debiting inventory. When we pay for freight, we debit freight in and credit our cash. When we return, we debit, of course, our accounts payable, but we credit an account called purchase returns, our contra account, basically. When we pay, of course, we debit our payable, but we credit our purchase discounts and cash. Then when we make a sale, we debit our receivable and our sales revenue. We do not adjust for the inventory that was sold. We do that only at the end of the period. Now, under the periodic system, we record the period end adjustment to our cost of goods sold. We're assuming there's no beginning inventory, and it's telling us our ending inventory has a cost of $2,859.50. So we're going to debit our ending inventory. Ultimately, that's going to be a plug-in. We're going to debit, that's not the plug-in. The cost of goods sold ultimately is the plug-in there. We're going to debit our ending inventory of $2,859. We're going to debit our purchase returns, debit our purchase discounts, credit our purchases, and credit our freight in to end up with our cost of goods sold to be $10,212.50. Now, if there had been a beginning inventory, we would want to credit that also to come up with the appropriate amounts. Now, what happens when we have errors regarding our inventory? It ultimately affects our financial statements, because if there's an error in inventory, it's an asset, it's on the balance sheet, and it ultimately will affect our cost of goods sold, which is on the income statement. So we're going to look at what happens when there are errors. As you see, this is a great example of understanding that our ending inventory is what shows up on our balance sheet. Our cost of goods sold is our expense on the income statement. If we overstate our ending inventory, well, that means our asset inventory is overstated. But doesn't that also mean our cost of goods sold then is understated? And if our cost of goods sold is less than what it should be, it means our net income is actually greater than what it should be. If we understate our ending inventory, show less than what we should, then that means we overstated our cost of goods sold, which means then we understated our net income or our gross profit. So an overstatement or an understatement in our inventory will ultimately affect our balance sheet and our income statement. Now, that's between each year. But in the end, over a 2-year period, it will all even out. It's just each year, those numbers will be incorrect. So as you see here, the ending balance of inventory in year 1 is going to be the beginning balance of inventory in year 2. So as you see here, the net effect between the 2 years will work itself out. It's just that each year, as you see here in 2018, our cost of goods sold show 3,100, where that's the correct amount. The incorrect amount shows our cost of goods sold is 3,200. And then in 2019, the correct would be 3,700. The incorrect is 3,600. Over the 2-year period, it's going to all equal out. It's just per year is when it's going to be off. In the current year, inventory errors affect the amounts reported for inventory and retained earnings in the balance sheet, and amounts reported for cost of goods sold and gross profit in the income statement. At the end of the year, the error has no effect on ending inventory or retained earnings, but reverses for the cost of goods sold and the gross profit. So guys, I want everyone to attempt this. I'm going to look and see what you guys all came up with. I'll give you a couple minutes here, but an inventory error that understates the amount of ending inventory will result in which of the following in the current year? A, overstated cost of goods sold. B, overstated net income. C, overstated assets. Or D, overstated gross profit. What do you think? How come I can't get that? There it is. Okay, so C, D, C, C, C. C, C, A, C, C, A, B, C, C, D, C. So the biggest one shows C, but guess what? It's A, guys, an inventory error that understates the amount of ending inventory will result in which of the following in the current year. If it understates the ending inventory, that means it's understating their assets, which ultimately then means it is overstating the cost of goods sold. So let's go through one more problem. I think we did a lot of these problems. Let's do exercise 620. Mulligan Corporation purchases inventory on account with terms FOB shipping point. The goods are shipped on December 30th, but don't reach Mulligan until January 5th of 2022. Mulligan correctly records accounts payable associated with the purchase, but does not include this inventory in its 2021 ending inventory account. So we have two questions. If an error has been made, explain why. And then if an error has been made, indicate whether there's an understatement, overstatement, or no effect on the reported amount of each financial statement element, and in the current year and also the following year. So it's telling us that Mulligan Corporation purchases inventory FOB shipping point. The goods are shipped on December 30th, but don't reach Mulligan until January 5th. Mulligan correctly records accounts payable associated with the purchase, but does not include this in inventory in its 2021 inventory account. Well, guys, when we're dealing with FOB shipping point, when does title pass? At the shipping point, at when they actually purchase the goods and they are getting shipped from the seller's location. Exercise 620. So as you see here, if we look here, goods are shipped FOB shipping point, then the title transfers to the seller, from the seller to the buyer at the time of shipment, which means Mulligan receives title to the inventory when it gets shipped on December 30th. So it did not include this in its inventory, so it's made an error. It has understated its inventory, which is an asset. It hasn't understated its liability because it said it showed the liability, but it's understated its stockholders' equity. There's no effect on revenues. It overstated its cost of goods sold, and it ultimately understated its gross profit. Now, in the next year, it understated its cost of goods sold and overstated its gross profit. So you really want to understand how, when there is an error, how it does affect the various years. So guys, we are going to end it here. I'm going to finish the recording. Hang in here. So I hope this was helpful for you.